All right, let's talk about something that can feel like a total black box in the world of finance: IPOs. But what if I told you it's not some exclusive club for the ultra-rich? What if it's actually a massive opportunity just waiting for you to get in?
You know that feeling, right? You look at some huge company, a real giant, and you just kick yourself thinking, man, if only I'd gotten in on the ground floor. Well, that's not just a daydream. That ground floor moment has a name, and that's exactly the door we are prying open today.
So think of this as your personal guide, your roadmap. We're going to walk through the whole thing step by step, from what an IPO even is, all the way to how you can make a smart, informed decision. Ready? Let's dive in.
Okay, first things first. We have to start at the beginning. So, what in the world is an IPO anyway?
Okay, so here's the simplest way to think about it. An initial public offering, it's like a company's big coming out party. Imagine a business that's been private, maybe owned by its founders and a few early backers. The IPO is the moment they throw open the doors to everyone and say, hey, for the first time ever, you can own a piece of us. They're selling shares to the general public. That's you and me.
All right, now this is a super important distinction that a lot of people miss. And I mean, it's crucial. See, not all these public offerings are the same. In a classic IPO, the money you invest goes straight to the company. They use it to grow, build new things, expand. But sometimes you'll see something called an offer for sale, or an OFS. And in that case, your money is going to the early investors or founders who are cashing out. So you always have to ask, is my money funding the company's growth, or is it just helping someone else sell their shares? That's a huge difference, and the answer is always in the fine print.
Okay, so we've got the what. Now let's figure out the who. As in, where do you fit into this whole picture? Think of it like finding your specific lane on the IPO highway.
So, when a company decides to go public, they don't just dump all their shares into a giant pile for a free-for-all. Nope, the pie is sliced up very intentionally. And yeah, you can see the big guys, the institutional investors, they get the biggest slice, a full 50%. But look at this, a massive 35% chunk is carved out just for retail investors. That's for everyday people like us.
So, which slice of the pie is yours? Well, it basically comes down to how much you're looking to invest. If your application is for less than 2 lakh rupees, you're what's called a retail individual investor, or RII. If you're going in with more than that, you're in the high net worth or HNI category. But here's the key. Look at the numbers. As a retail investor, you're tapping into that big 35% allocation. The HNIs, they're all fighting over a much smaller 15% piece. That's a really important strategic edge to understand.
And this leads us to maybe the biggest takeaway here, a real gem. Because of that big 35% slice and relatively less competition, the retail category, the RII category, flat out gives you the best odds of actually getting an allotment. Just knowing that one simple fact can seriously tilt the scales in your favor.
All right, you've got the basics down, you know which category you're in. Now for the fun part, the actual application quest. Let's walk through the mission, step by step, of how you actually do this.
So what's the plan of attack? It's really just 5 simple steps. And step 1 is non-negotiable. You've got to do your homework. That company's prospectus, that's your secret intel. Read it. After that, you'll pick your application method, decide on your price, put in your details to get your funds blocked, and then you wait and watch. It's a pretty straightforward process when you break it down.
Okay, pro tip alert. This one's a game changer. You'll want to use something called ASBA when you apply. Now, that sounds technical, but here's what it means. Your money doesn't actually leave your bank account. It just gets blocked. It's still sitting there, earning you interest. If you don't get any shares, poof, the block is gone instantly. No chasing refunds, no lost interest. Seriously, it's a no-brainer.
Okay, so you've done the work, your application is in. Now we're in the final stretch. This is the countdown, from the moment the IPO closes to the big day when trading actually begins.
So here's how it usually plays out. You've got about 3 days to get your bid in. Then the IPO closes. A couple of days later, they finalize who gets shares. The very next day, if you didn't get an allocation, your money is unblocked. And then boom, day 8, 10 a.m. on the dot, that stock starts trading on the market. It all happens really fast, usually in just over a week.
But hey, what if an IPO is a total flop and nobody's interested? Well, there's actually a really important safety rule for that, and it all hinges on one number: 90%. An IPO has to get at least 90% subscription to even happen. If it doesn't hit that mark, the whole thing gets called off. Everyone's money is unblocked, no harm, no foul. It's a built-in protection so you don't end up investing in a company that nobody else wants.
Now, after a company's trading for a while, you might hear weird terms like stock split or bonus shares. They sound complex, but they're really not. In both cases, the company's just changing the number of shares. For example, they might turn your one share into two. But, and this is the key, they also cut the price per share in half. So the total value of what you own, it stays exactly the same. It's just accounting, really.
All right, we've walked through the whole A to Z process, so let's bring it all home with the most important piece of the puzzle, the actual strategies. How do you turn all this knowledge into smart investing? This is your treasure map to doing it right.
Okay, before you even think about hitting that apply button, run through this checklist. Seriously, have you actually read the prospectus? Do you know who's running the company and what their track record is? Do you know what they're going to use your money for? How does its price stack up against its competitors? Are the big money investors getting in on it? And maybe most importantly, what's your plan? Why are you buying? And when would you sell? This isn't just busy work. It's what separates smart investing from just gambling.
And look, knowing what to do is great, but knowing what not to do can save your skin. So please avoid these classic mistakes. Don't invest just because you saw it in the headlines. That's called chasing hype. Don't go in expecting guaranteed profits on day one. There's no such thing. And please, for the love of all that is holy, don't invest without having some kind of exit plan. Sometimes the best move you can make is avoiding a bad one.
So there it is, the world of IPOs, cracked wide open. It's not so complicated, right? From what it is, to who can invest, to how you can do it smartly, you now have the map. The only question left is, where are you going to start your journey? Thanks for tuning in.